Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Hello, welcome to another episode of Broker Daily Uncut, looking at the mortgage world of Australia, keeping an eye on the economy, property and everything in between. I'm joined, obviously, as always, with Costa from Finni and Robert as well. How are you guys?
Good. How are you?
Good. Bit tired after a long weekend, but got out of bed and here I am.
I was going to ignore the tiredness from the long weekend and just keep on rolling because obviously Tuesday always feels a bit different, going straight into the podcast, but that's great. And obviously we're at the time of the year now, I feel, where we can start to kind of see the trends, start to see how kind of 2026 is going to evolve, how it's actually looking. Obviously anything can happen, and this year has proven that, as every year does. But guys, let's start a little bit. I don't want to touch on auction rates too much because obviously we've had Anzac Day, it's slightly different. But what's been going on there, Costa?
Auction results are quite significantly low due to the Anzac Day falling on a Saturday this year.
Yeah.
I don't believe they were able to do auctions until 1 p.m. onwards.
Oh, right, okay.
So, Sydney was under 50%. I wouldn't really take much out of that one. I guess we'll see what happens next week and going forward because there's no long weekends for a couple of months as well. So it's just going to be,
Yeah. Absolutely.
Constant auction results.
I mean, they have been subdued, but they have been obviously for this week. There is clear reasons for that, but we've kind of seen them at a lower ebb for the last couple of weeks now, and obviously that's one thing that we've been talking about on the podcast quite a lot. Something else, obviously, we've been talking about is that the kind of two speeds in the economy that we're seeing, or multi speeds, dare I say, and some data that really caught us this week was from Catality, and it was looking at everything around the 5% deposit scheme, but also looking at the more broad factors that we're seeing in the market. So the main kind of headline from this is that lower price homes are significantly outperforming higher price homes. So properties under the 5% deposit scheme caps are rising at 6.7% in the 6 months up to March versus 3.6% for homes above the threshold. Obviously, that's a real market difference. And I want to unpack how that's kind of varying regionally, how that's varying from, the different states, but also why it's happening and if it's just the 5% deposit scheme or if there's some other things. But let's just start firstly is with your own experience there. Is that something that you're noticing that when you're looking at when you're looking at these homes, are you seeing that kind of speed increasing at the lower end more?
Yeah, well, as you said, you got more people entering the market now with this 5%. I think we had a massive amount of people jump onto it when it came into effect late last year. I think it was September, October.
It was October, I think.
October.
Yeah. The scheme as it stands today. Yeah. October,
had massive amounts of people entering the market. So prices did rise. It's obviously come down a little bit, and that was sort of expected because as everyone comes onto it, it's slowly just going to even out over time. But yeah, I guess it's probably would say multiple things. You've got people with the 5% deposit under the 1.5 million. That's Sydney talk. But you've also got investors that are around that market. Obviously not around the 1.5, but around the $700,000 to $800,000 mark. That a lot of people are entering there. And I think we were talking before. Even Robert was mentioning just FOMO in general. A lot of people were talking and just feel like if they don't get in now, they'll miss out.
Yeah.
That's right. And just to also add to that as well, it's just since October also, the income cap, they also have removed that as well. So actually it made it a lot more open to the broader market for first home buyers as well, for owner occupied, which made it a lot more people with their serviceability to be able to get into the market for that very reason too.
Yeah, absolutely. And I did see something within there. So we did a piece on Broker Daily kind of looking at, is it just the 5% deposit scheme here that's causing these prices to spike, or is there something more? And I think that what came out of my conversations at least was there's kind of three things going on here, right? Obviously the 5% deposit scheme is causing a massive impact on the market, but we're also seeing, so obviously investor demand is up. It's making up about 40% of mortgage demand, which is up. I think it was in the kind of mid 30s last year.
I remember discussing this on a previous Broker Daily episode. So
And this is exactly where they're after.
around 36, 37%. So yeah.
And then you're also, of course, seeing, I mean, a really interesting kind of graph, I thought, was the kind of graph over time of how much these two price points have split. And you see that the split is happening actually. The first time it's really recorded properly this time round is the 24th of August last year, which is way before the scheme. It's when the scheme was announced, right? So you're seeing people that are trying to get into the market early, that are kind of potentially looking at it. So you're seeing those kind of FOMO buyers that you just said. But on top of that, now we've got the higher rates. You're also seeing people going, perhaps maybe we should look at serviceability. Maybe our serviceability is a bit lower. Maybe we should look at, lower price homes, which again is adding pressure into it. Is that something that you're seeing?
Yeah, well, I'm just looking at your number, the graph and details that you've got here. In somewhere like Brisbane, September 25, 42% of homes you could get with the 5% deposit scheme. March 26, it's now at 28%. That's a huge drop.
Yeah.
Like that just means less properties on the market. And again, it increases the value and...
Perth as well. The portion of suburbs with a median value at or below the price in September 25, 33%, so a third of suburbs. Now that sits at 11%. Like that is a massive change in the market of where you can live, right?
And again, like you mentioned, we've got interest rates going up twice, a third pretty much likely next month. And that cohort of just price point is it's going higher and higher. And that other price point is, well, in Sydney and Melbourne, that's actually gone back. In Sydney, it's gone 1.5 million and above has gone back 1.1, and in Melbourne 1%. It's not massive numbers, but it's still going back. But all the rest, Brisbane, Adelaide, they're all going up. So I guess in the end, if you want a roof over your head, you're going to have to just pay whatever you need to pay.
So the caps in Sydney and Melbourne seem to be kind of holding firm. So you're seeing 47% of suburbs with a median value below the price in September, and now it's 46. So that's kind of saying a bit quite stable. Units as well, around about the 90% mark. Melbourne's also similar. The other states, that's where the issues are arising. Obviously, that begs the question, do the caps need to be raised? But then obviously, if something like that happens, what do you do about stamp duty? What do you do about all the different things that you start bumping against those kind of issues as well? But Sydney and Melbourne, obviously the prices have flattened out there a bit anyway. So maybe that's the key reason. But you're still seeing the other, capital cities, the prices, the price growth is massively outstripping.
I think as well, again, just when I've been talking with some buyers agents, especially around Brisbane, around the Ipswich area, you can easily buy a house under $1 million still there. Like I just think the amount of properties that are under that cap in Brisbane compared to say Sydney is just tenfold. Like Sydney, where are you going to buy a house for $1.5 million? Yeah. That doesn't need a significant amount of work.
That's right. Yeah.
Whereas in Brisbane, it's still got plenty. So those numbers are increasing probably because of that as well. So
yeah, absolutely. But this has flowed on to a bit of data I want to just read out for you here. So as to how this is kind of flowing on to first home buyers. So Australian Bureau of Statistics data shows that the average first home buyer loan has increased by 7.7% in the December quarter to $606,000 now. However, the subsequent rate rises have reduced borrowing capacity, with a household earning $100,000 or less now able to borrow around $34,000 less than they were prior. So you are seeing these kind of mix of things that you've got, house prices rising, but obviously you've got serviceability going down. So that's, producing this kind of situation where people are being pushed down the property ladder potentially.
Yeah. Yeah, no, I think it's a good way.
Yeah. Guys, we better take a quick break there. Back in a moment. Welcome back, Broker Daily Uncut. Now, following on from what we were just talking about before the break, I wanted to just quickly highlight APRA and some news from them. So they've confirmed a sharp rise in high LVR lending, which is obviously related very much to the 5% deposit scheme. So banks are now writing $5.4 billion in owner-occupier loans at 5% deposit or less in the December quarter, which is up 63% quarter on quarter. That shows that the impact this is having on the economy. And obviously, we'll see as this year goes on whether that remains and obviously the implications around that. Obviously, APRA says that this increase is expected given the scheme's design, and it's just something that they're kind of monitoring. And on top of that, they did note in this piece that the 3% serviceability buffer, that's not going anywhere. So obviously, we were talking about serviceability just before the break. Now, what kind of serviceability are people looking at with that buffer on top, roughly? Do you know?
Well, I don't know a figure, but in relation to the servicing buffer, I know there was talk about it last year, about maybe dropping it to 2.5.
Yeah.
With sort of the cost of living crisis, interest rates going up, I just can't even see entering the conversation anymore. I guess the banks, well, yeah, listen, I don't know where I can go with this, but I just don't see it moving. You probably have to just go to your second tiers. It's just too much of a risk at the moment to even consider moving it.
That's right, because with the 3% buffer, at the end of the day, the bank is putting that buffer in place in case the rates ever get to that point.
Exactly.
Right? So if they see the rates are going back up, there's no certainty in terms of where inflation is going to sit for the next 6 to 12 months. They're going to need that buffer to show that there's responsible lending, especially with major lenders. And then, yes, if they can't meet that criteria, then they'll look at the non-bank lenders for lower buffers.
Absolutely. And obviously, the buffer's there to kind of protect borrowers, right? And obviously, one of the big cohorts within this 5% deposit scheme is new borrowers, younger borrowers, people that are just entering the housing market for the first time. And within that, I want to highlight Gen Z. Obviously, I think that's around. I always never know about where these. I think it's around between anyone up to about the age of 29.
Yeah, I think
is
it's
around
like
about
20s sort of.
Yeah.
People.
Looking at kind of where they, because obviously the 5% deposit scheme, it's not exclusively for kind of younger people, but it affects them majorly as they often don't have the larger deposits. They're often not on the property ladder already. And obviously things like serviceability are a big thing for them. They also need that education to know, which I want to unpack. So the first thing I found interesting was, I think this was one of the majors, read about it on brokerdaily.com. 35% of Gen Z is planning to buy within the next 5 years. Now that's planning, right? So we'll see where that goes, but it shows the intent, and it shows that there is a lot of people wanting to enter the housing market, but not for the reason of just owner occupying. I don't think. I've seen when I talk to a lot of brokers, and also a lot of people that I talk to on my daily beat, it's rentvesting. It's investing. It's looking at maybe buying a place to get yourself into the property ladder, but not necessarily living in it. Can you guys unpack that? Is that something that you've seen? Are you seeing younger people moving into the investment space to do, let's say, rentvesting?
Yeah, well, I've had a few that are rentvesting as well. And I think you need to look at it from a generational sort of way. Yeah. Whereas back in the day, it was, get married, have kids, have the family home, settle down, be done. Whereas to now, a lot of it's more about lifestyle. I want to live close to the beach. I want to live in the city. I want to live in Darlinghurst so I can go out to dinners, drinks and all that. So I think lifestyle plays a big part in the way people think on how to live these days. And can you purchase a property in Darlinghurst, a 2-bedroom unit for you to live in? If the answer is no, they're going to be like, well, I might as well put my money to work for me somewhere else, and then I'll just rent in Darlinghurst. So I think Gen Z and the one before it or whoever they were, I think the lifestyle comes into play as well, not just sort of, get married, have kids, have a house, and just be done. So it's a different mentality.
That's something that came out time and time again with the conversations that I had when we were writing some stuff on this, was that it was a lifestyle thing often. So they could live in it, but they wouldn't want to, because they want to live somewhere that is way further outside of their kind of price points. So they'd kind of use it as a means to get on the property ladder, rent it out, and then kind of move. Potentially not even in the same city, right? It could be anywhere else in the country. Because obviously, as soon as anyone knows in the investment market, as soon as you're not going to live in it, the sky's the limit as to where you're actually going to 100%. Buy. Then suddenly you're like, oh, I'm not going to buy next to my family, or you can buy anywhere. which obviously change it. Interestingly, ownership is still low. So I think it's about 16% of Gen Z actually owns homes at the moment. When you compare like baby boomers at the same time, I think that was around 30 when they were at the same age. Obviously, there is many different barriers.
Funny that you bring that up. I was reading this morning on the train to work. Boomers, it was 3 to 5 times their salary to purchase a property. Now it's 13 to 16 times the person's salary to purchase a property. Like that's massive. Like, and when you think about, you need to get the deposit as well, which has skyrocketed. We're talking hundreds of thousands, plus your stamp duty on top of that as well. Yeah. It is getting harder and harder. So
stamp duty, price points, and also at the same time your the CPI for your salaries is only increasing steadily compared to how it was back then as well. Yeah.
Absolutely. Do you think there's a slight cultural thing here though as well? Because obviously there's the investing side of things. I'm a young guy. I don't know the past as well, but there's obviously, in my generation, I feel that there is a lot of how can you get into the market? How can you be smart with your money? Obviously, I want to unpack social media in a minute, but we're surrounded by people telling us that you can make your money work for you a lot more. And also that homes are assets. They're not homes. They're things to make money out of, even if you are going to live in it. So it was Great Southern Bank that did this research that found that Gen Z respondents are 50% more likely than the average Australians to consider rent vesting, 21% compared to 14%. And when it came to motivation, they asked them about motivation. So for Gen Zs, generating rental income is 36%, said that as the thing. Guessing the market sooner, 22%. And viewing property as a comparatively lower risk investment strategy, 17%, which kind of shows that it's not just about, I want to be on the property. There's lots of different kind of reasons people are thinking about why they want to be in. And obviously that's amplified by social media and to a certain extent AI, as to what you should be doing with your money, right? And what you should be doing, and the traditional kind of life of where you should, your life pathway that you should be taking.
Yeah, so I find that from the baby boomers that I've been speaking to in the past is that majority of them only look at financial planning when they reach at a certain age, when they look at to retire, or in terms of handing down to their kids. But now a lot of kids, the next generation, what they tend to look at is how can they build on passive income? How can they build a portfolio in terms of whether retiring early or in terms of how they can actually find ways to make extra money. And they can obviously see property as another avenue because, as we know, we can't build more land, but at the same time, it is one of the safest commodity in terms of most asset classes. Yeah. So that's why, and from what they're reading as well, whether it's talking to buyers agents or talking to accountants, whether it's for tax advice, they're finding out that getting into the property is a great way to really leverage and also build on, capital growth or equity for other investment in the future.
Yeah, absolutely. And obviously, I think that's a good shift to be thinking about your money, to be thinking about your property.
I think you're 100% spot on there. I was having a conversation with my wife recently, and the conversation has already started. Like, all right, what does 67 or 65 look like? And then you need to paint that picture and be like, all right, how do I get there? Yeah. Because you can't start 5 years out. You need to start 20 years out, 25 years out. So it definitely is part of the conversation now. And like Robert said, the older generation, I just don't think they discuss those sort of things. It was just, I'll sort it out when I get there. And they clearly did always sort it out. I guess maybe because it was a bit easy in regards to just sort of salary and what you can do with your life back then. And now it is a bit harder with, cost of living, your salary, you're taxed. We're the most taxed we've ever been in our lives. So, someone that's earning 200 grand today compared to someone who earning 200 grand 15 years ago, they were cheering. Whereas to now, 200 grand isn't a lot of money, but you're still going to stay taxed at the same rate. So I think these sort of discussions need to happen much earlier than what they did previous generations. Yeah,
absolutely. As you say, kind of pick that end point and see how you're going to work there. And obviously, I think going back to the first section, I think these price increases will bring that into focus because perhaps if you're not on the property ladder and you go, you live in Perth and you go, oh my God, if I got into the property ladder 5 years ago, my house would be worth X
100%.
amounts.
Yeah.
And it's not a static target right now, is it? It's something that you know, and within that, obviously, and it's a perfect segue into something else I really want to talk about with you guys, is that kind of social media side of things. That just because ASIC has released some warnings and it's joined 16 global regulators in a crackdown on unlawful influencers. Because obviously, as I said, like here, you know, you're seeing financial advice being doled out anywhere now.
Yeah.
You know, it's not the same as, you know, the baby boomer generation where on property they would go to special people. They'd maybe go within their family for the advice, rather than scrolling down on your phone and seeing these people that have allegedly made a lot of money. So
I love the allegedly.
I should put that in there for legal reasons. So obviously ASIC has been issuing warnings to creators giving unlicensed or misleading financial advice. It kind of comes as younger borrowers are leaning more heavily on digital channels. 63% of Gen Z are using social media for financial information, and 64% say they trust AI platforms. Guys, reactions?
I would continue from what you were saying with the rent vesting before. There's, I won't say names, but I'm sure people probably pick up who it is. There's one influencer out there who pushes rent vesting as the holy gospel. And, you know, like, I don't know, when it comes to social media and taking advice, we've spoken about this previously. You got to take it with a grain of salt. You really, really do. Just because they've got a phone and they've got a TikTok account doesn't mean they know anything.
Yeah.
Just because they're showing you, you know, they're in a Ferrari or in front of this property doesn't mean it's theirs. I'm not saying they're all like that, but in the end, you shouldn't be taking advice from people on TikTok.
Yeah, and it goes to show. So I talked to a broker last week who said that he would, when he talked to his younger clients, they would often send him during the process TikTok videos.
I've had that.
I want the.
Have you? I've had that. I've had that, and also, ChatGPT told me this. I'm like, oh my god. And then they don't. And you know what? Like, it's not always wrong, but it doesn't tell you the whole story, and that's where they miss out. Like, they tell you 50% of the information. Yes, that's right, but X, Y, and Z, and they're like, oh, so I can't do it. I'm like, well, no, you can't, because ChatGPT isn't. It's only answering that one question that you've asked, but you need to ask more questions in regards to what you've asked to find out the full picture of how it works.
Yeah, absolutely. It's obviously always a great starting point, I think, for getting into, well, I guess for younger people who may not know, you know, they're not going to be picking up a book on mortgages or finance. So it's a good starting point, and I'd always encourage, when you use any kind of AI, including just the Google bit at the top, you can see where the links are from and you can click on them.
Yeah.
And often there'll be brokerages, right? And there'll be reputable brokerages that you can, you know, pick up the phone and call 100%. Them and talk to them and find out a bit more, rather than just taking the kind of faceless information at face value.
And even just to add to that as well, like even from our side as well, like, you know, just from Finni, like we've got a lot of clients like have similar mentality. They think, okay, this person, my friend's got this so much serviceability, why aren't I getting the same? Right? So from our side, obviously we've got over 30 different lenders on our panel, but every lenders have different calculators that constantly update, and different serviceability and different appetite and different policy as well. And we've got to see in terms of what fits for their particular needs and how are we going to be able to give them the maximum borrowing. But it's going to be different to the person that we spoke to previously. So it's always good to go to a broker for them to actually understand the situation, rather than going directly to a bank as an example, because otherwise that bank can only offer in terms of what they know or what they can do. Whereas what we can see is that we see the whole picture and see what fits with their actual need.
Yeah, interestingly, it kind of it reinforces the kind of role of a broker, right? 'Cause it's not just about kind of writing lens now. It's also being a financial fact checker, you know, saying, oh, well, that's not quite right.
Yeah.
That's not quite how it works.
As Robert was saying, if you're going to go direct to a bank, they've got a product to sell you. And that product is what they sell. Whereas at a brokerage, we've got nothing with anyone. We're just going to take you to what best suits your needs. And that may not be one of the major banks. That may be, you know, a smaller bank like, you know, ING Bank West or something like that. But we've got no alliance to anyone. So you get that sort of comprehensive overview of your whole situation and what bank fits you best. Whereas if you go to a normal bank, they're just going to sell you your product and say we're the perfect fit for you when technically you're not.
Yeah, super interesting, guys. We better take a quick break there, but back in a moment. Welcome back, guys. Broker Daily Uncut. Now, just to finish off, I want to talk a bit about policy, as we always do. And I want you to unpack a part of lending that sometimes I kind of dance around because I don't always understand the ins and outs of trust lending. But let's get into a little bit about it. So NAB have adjusted their trust lending policies, haven't they? As a lot of other banks are kind of tightening this area of lending. So trust lending now is maxed at 80%, I believe, with no
80%
cash
LVR,
outs.
correct? And they no longer do cash outs for trusts.
So is that kind of in step with the rest of the major lenders? Like, what's the kind of landscape here and now?
Yeah, a lot of lenders are tightening the belt when it comes to trust lending. The famous one being Macquarie, who are totally out of it. You've got ones like Commonwealth Bank and ANZ where they've restricted their policy, and I think you also have to be a current. You have to have an account with them at the moment to even be considered if you're a new person.
Annual sales, isn't it? Yeah.
Current credit facility holder for at least 6 months.
Yeah, there you go. So, yeah.
So can I ask you both, why are the majors shying away from trust lending so much?
The risk factor, I think, is getting a bit too much. And going back to when we're talking about finfluencers, a lot of these influencers on TikTok were just saying, do this, do this, do this. And it was basically sort of bending the rules. So say, for example, I purchase a property in Costa Trust. That property is worth $1 million and I get an 80% LVR. So I've got $800,000 in there. And each year, let's say, for example, it's costing me $20,000 to upkeep that trust. I go purchase another property and I put it into Robert Trust. I can say to the bank, Costa Trust, by just going to my accountant, write an accountant's letter saying, this trust is trading profitably.
Yeah.
The accountant doesn't really care. They're just going to write the letter. Not all accountants are like that, I should say, but there is a segment of the market where they're just writing the letter, even though it's costing me a lot of money. They're just going to say it's trading profitably. So then I can get my servicing up here and purchase this property. When in reality, I shouldn't be able to purchase this property because I almost don't have enough money to be able to fund all these properties. So it was an easy way to sort of get around the rules and to purchase other properties. And people were doing that multiple times.
Yeah, chaining it up, right?
And just to piggyback off that as well, is that using that example that Costa's mentioned as well, is that, say, for example, if in Costa Trust 1, if had he or someone else had a similar sort of setup that he put in, let's say, or he or she put in 200,000 into the offset account, now that repayment is a lot less than what it would be if that 200,000 was not in there. Now that allows that monthly repayment to be reduced, but also your overall expenses obviously will be taken into account. The net profit now of that trust now is positive. And if that counter can see that, he's happy to write off that letter, right? Now, he's writing based on that at that point in time when he actually had viewed the situation, and it's always on historical data, right? For the next day, he could that individual or that he or she can actually take that 200,000 and purchase something else.
I'll just put it straight out the offset and then move it to something else.
Yeah. So from a lending point of view, and again, there's obviously a lot of areas that we can discuss about in further detail, but with trust lending, a lot of lenders are holding back on it. It's obviously one of them is anti-money laundering, but it's also overexposure as well in terms of lending, because if interest rate does go up, that's what makes it a lot harder for some of these existing trust lending to be able to sustain the repayments.
Yeah, absolutely. And it seems that, as you say, that kind of chain reaction there of being able to build trust on trust and trust is not going to produce a situation. Let's say the rates, really do skyrocket.
Yeah, well, at the moment they are.
You could exactly at like a moment like now. What's the regulatory kind of situation here? What are the regulators kind of seeing on this? Is this above board? Is this fine, or are they looking at this as something that they want to crack down on?
I was going to say, I think they are. I think the lenders themselves are probably cracking down on it before anyone else comes down on them,
right?
Because they have seen what's being played out, And again, like an accountant, like Rob just said, they're going off historical data. Yeah, it's running profitably, tick it off, done. But as soon as you take out that $200,000, you're now funding it. And that $200,000 might go to purchase another property. So yeah, it's an interesting space. And, it was happening more late last year, early this year, where a lot of policies were coming in. Didn't hear much about trust lending for the past month or two, but now NAB's come up with this. So,
What about ANZ? So ANZ, I believe, is with only existing customers. Is that right? It's something along those lines.
Yeah, something like that.
They tightened things earlier this year, didn't they? And then it was only, is that so they can have a bit more on the books to know what's going on with the customer, or what's their view there?
Probably to weed them out. So you don't have new customers coming to you just
purely for that.
Yeah. Whereas you've got current customers, so instead of 100 people coming to you per week, that now drops down to 50. And then your risk factor goes lower because you're not exposed as much.
And how's this feeding on to demand? Is the tightening of the policies meaning that you're not seeing as many investors wanting to go into that trust lending space? Are you getting just as many inquiries as you were, let's say, 6 months ago?
Because a lot of the time that we see a lot of clients come to us, they've either gotten advice from the buyer's agent for a particular certain structure setup, or from their accountant. We are seeing less from clients in generally speaking, looking at trust lending, just because they see that it's a very murky water, and some are also rate driven. So say, for example, when we were talking about earlier, certain areas where we're talking about Victoria, which a lot of buyers agents are actually buying at the moment. If they're buying through trust lending and it can't become positively geared within a year or 2 years' time because of the yield, then it doesn't fit into their strategy, because the rental's not covering all their outgoings. So for that reason, some of them rather buy in their personal name for better serviceability, but also for tax purposes as well.
Yeah, absolutely. And what about the kind of non-bank space here? I remember seeing things that, a lot of non-banks kind of stepping forward to kind of fill that void. Are you seeing more non-banks come out with more kind of competitive policies here, trying to kind of bring, or are they also kind of going, ooh, this is a risky sector? I'm
trying to think.
So from the non-bank lender sort of space, they're still open for business. Nothing has changed from their front.
There you go.
A lot of them still take negative gearing for trust lending, and they also accept our accountant letter as well to exclude certain trust debts as well.
Yeah, wow, a really interesting space, and I'd imagine we're going to see it develop over the years, guys. That is all we're going to have time for this week. But thank you so much for joining me, as always.
Thank you.
If people want to get in touch with Finni, find out a little bit more about Finni, where can they go?
Finni.com.au. Click the book now button and pick your day and time, and you'll be selected to speak to one of the brokers.
Ideal. And as always, if you want to get more from Broker Daily, go to brokerdaily.au. You'll find news, features, podcasts, and all the rest of that good stuff. Thanks very much for another week. Goodbye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.